The Icons of Real Estate Podcast. Are you ready to learn the proven money-making secrets from top-producing Icon agents? Ready to skyrocket your business? This podcast is for you. Tune in every week with your host, Tomasz Fonseca, and find out how to implement proven strategies to 10 times your business, from $3 million to $30 million in just 12 months. Brought to you by the Masters at Real Estate Marketing, Ardor SEO.
Welcome to the Icons of Real Estate Podcast. I'm your host, Patty Teal. Let me tell you about today's featured guest. His name is Sterling Chapman. Sterling is the president and managing partner of Crestworth Capital. They help small business owners and professionals to earn enough passive income to live the life of their dreams. Doesn't that sound nice? Sterling has mastered the art and science of sales, funnel management, marketing, account management, strategic business planning, and financial forecasting. Welcome, Sterling.
Thank you, Patty. Appreciate you having me on.
Oh, it's great to have you on. So, Sterling, what we usually do is we have our guests start with their story into the business that they're doing now and how you got to this level of success and where you started, and just tell us your story.
Sure. So I started, in 2017. I wanted to be the next CFO of some major corporation. I was in corporate America, and I was finishing my MBA, and I was taking some entrepreneurship classes. And I thought, man, it would be so cool to do something, that I had control over, that was making me money instead of somebody else. I just didn't know how to do anything. So I didn't have any specialty knowledge. And I was working in telco, and I didn't know enough to go start a telco company. I don't know that you can even do that. But between the leadership and the entrepreneurship classes I was taking in my master's program, and then I read a book called Rich Dad Poor Dad, and it talks about buying income producing assets and all the tax benefits and trading your money for time versus all these other philosophies and ideologies around that. And it just blew my mind. And it sounds like the main topic there is you can buy real estate and rent it out, and then you can get passive income from it, and you can get real great tax benefits from it as well. So I started reading everything I could about. At the same time, people were getting surplus from corporate America where I worked, and the dream started to seem a little less stable than I'd always pictured it. I was dedicating 80 hours of my life to this company, and at any point they could just turn the faucet off. So I wanted to take more control of my life, and so I started listening to a lot of Bigger Pockets podcasts, reading a lot of books, and listening to a lot of audiobooks, and buying rental properties. I saved up down payments, and I bought 2, and I was out of money, and I was frustrated because it was going to take me a year to save up another down payment. And I thought, I'm not moving quite as fast. Like, it's going to take me forever at this pace. So I started learning about some more strategic techniques to kind of get into the process and around kind of using other people's money. And, I took advantage of seller financing and some other strategic and creative ways to buy properties without your own money. So partnerships, seller financing, and what we call the BRRRR strategy. So it's buy, rent, rehab, refinance, and repeat. So essentially, you borrow money from a passive investor or from a lender of any sort, and so you get the cash in your bank, and then some people start with a HELOC from their home equity, and then you go buy a distressed property way below value because people give you a discount because if you have to do the work, right? So you buy a property way below market value because it's distressed. You renovate the property, now it's worth a lot more. You go to a bank and say, hey, I've got this, nice fixed up property. Can you give me a mortgage on it? They'll give you an 80% mortgage on it, which cashes out your investor and gives you that money back to go buy another one. And so it's a repeatable process. And I over a couple of years, I was able to build up a multi-million-dollar rental portfolio with the same money just over and over again, recycled through that process. And then I, as well as a bunch of duplexes and fourplexes through seller financing and stuff like that. And I realized that managing those properties was no more fun than working. And
That's
it wasn't
funny
really
because it was working.
yeah. So it wasn't really a scalable solution. So I read a book by a gentleman named Joe Fairless about apartment syndication. So I started my podcast, the Rent Roll Radio Show, to kind of, just really to continue networking and learning. So I just interviewed a bunch of really successful investors and, people let everybody listen to me do it. And from there, I started to, go to conferences and learn more and more about apartment communities and how those are purchased by everyday folks, like myself. Like, when you're little and you walk by one of these big apartment complexes, you're like, oh, some big shot on Wall Street, some big investment firm must do that. But a lot of them in today's environment, with the ways the laws are and the exemptions from the SEC that are available, it's really just like, a lot of kind of everyday folks like me who, put together the projects. They raise funds from their friends and family or from other retail investors, and we pool it all together and we go buy these apartment complexes, and we, just like flipping the houses, we flip the apartment complexes. It just takes us 5 years to do it. So, so that's where I've spent a lot of my energy over the last couple of years, either raising money passively to buy apartment complexes and increase the value there, or manage my rental portfolio, or flipping houses to come up with more cash to buy more apartments.
I'm very impressed. I mean, really, you said that was in 2017 that you were working a job. And, so in 5 years, look what you've accomplished. That's pretty amazing.
Yeah. It was a great time in history to do it. Right.
Well,
So,
you got lucky there. Yeah, that's true.
We had a lot of tailwind. So I don't know if you've seen the news, but, real estate prices just shot up.
I saw that on the news.
So,
Right.
It was.
And rents too.
Yeah.
So,
Yeah. Which is the rent is the main driver in the price of the apartment complexes. So like some apartment complexes that we bought in the beginning of 2021, and we're like, okay, after we rehab it and renovate it, make it look nice, like we might be able to move the rent from $700 to $1,050. Well, those apartments are now getting $1,450 a unit.
Wow.
So it's been, the market has definitely been our friend.
Yes. So where are you located, and do you do business outside of your local area?
Yeah, so I'm in Baton Rouge, Louisiana, and I buy apartment complexes not in Baton Rouge, Louisiana.
Okay.
So my rental properties and the houses I flip are in Baton Rouge, Louisiana, just for convenience. And I always say, like, there's ways that you select markets for long-term growth to ensure demand, and I'll be happy to cover those. But at the end of the day, like, people make money in every market in America, but you just pay a discount for the markets that aren't great. So like I buy the houses in Baton Rouge, Louisiana. I know the neighborhoods like the back of my hand. Like, I know if it's going to be a good neighborhood, I know, and I'm not in it for a long time. You know what I mean? So the long-term implications of that are, I lost my train of thought now. It's not important when you're flipping a house that you're only going to be in for 3 months, but when you're buying a $10 million apartment complex that you're going to own for 7 years, you want to make sure you don't buy it in Detroit right before the auto industry goes overseas and the asset values drop to nearly nothing. So typically when we're looking for markets that we buy apartment complexes in, we look at the population trend. So like, are people moving there or are people moving away? We look at the job trend, right? Are they adding jobs? Are they losing jobs? What are the jobs paying? What kind of job diversification is there? So like, like in Detroit, like the whole town was propped up by the auto industry. So when it left, it created a huge void, which caused major occupancy issues and wrecked the whole local economy. There's towns in South Louisiana where it's like the whole town lives off of the oil industry. And if that were to go bust or there are change laws or whatever, like that would make wreak havoc on the local economy and cause high vacancy, which causes property value drops. So that's like a dangerous move. So we look at areas like Atlanta, Georgia, or Charlotte, North Carolina, or Houston, Texas, where there's like a real well-diversified economy where like if one industry or one employer was disrupted, it wouldn't disrupt the whole economy. So, we bought assets, like I said, right outside of Atlanta, right outside of Charlotte, right outside of Houston.
What about Florida?
We love Florida. So,
okay.
Florida's, there's, like I said, there's a price you pay because the areas that are great to buy in, unfortunately, everybody knows they're the areas that are great to buy in, right? So there's this like continuum of like, all right, is it a bad market? If it is, what's the discount? And like, is it a great market? If it is, what's the premium you're going to pay because of the competition? So like, I love Florida. I'd love to own everything in Florida. Florida's a great market. Florida's booming. The problem is everybody knows that Florida's a great market.
Right. So you
which drives up the price and the competition.
Right. You want to maybe find areas that not everybody knows are about to explode.
You want to be the first to the party, but
and that must take a lot of research.
Sure.
Yeah. So I wanted to ask you, the people that do deals with you, I know there's a lot of ways that people can partner with you and your company. Can you tell us some of those ways that they can work with you? Investors.
I typically work with people in two different fashions. So one is on the single family side of my business. I like to use private lenders where we just pay a fixed rate of like, because I use their money to buy the houses to fix them up. But that's a very small proportion of the capital that I raise. The majority of the capital that I raise is equity partnerships in the apartment complexes. So, as a syndicator or an operator of an apartment syndication, what me and my partners do is we raise capital we take your money, we take our money, we put it all together. We buy an apartment complex, we increase the value over 5 years, and then we sell it for a big payout. And you as the investor takes a large majority of those profits. And then we take a smaller piece of the profits for putting the project together.
Right. So is a lot of your time spent finding those investors?
Yeah. So, there's a few different roles and responsibilities within like the apartment syndication model, right? You have folks that focus on the acquisition, like they're finding the deals. You have folks that focus on the underwriting. They're underwriting and making sure it's a good deal. You have folks that focus on the asset management. Once you buy the project, somebody has to sit there and babysit the construction companies and babysit the property managers and go back and forth with the bank and make sure that the asset is running smoothly. And then you have to bring the money to the project. So I have 3 partners in most of my projects that I work in. And, we have a guy that focuses on acquisition, a guy that focuses on underwriting, a guy that focuses on asset management. And I'm actually the guy that focuses on raising the capital. So I'm constantly trying to kind of tweak my model because I live a bit in 2 different worlds. A lot of folks that focus primarily on flipping houses focus primarily on flipping houses. And a lot of people that focus primarily on syndicating apartment complexes focus primarily on syndicating apartment complexes. As somebody who does both, it's a lot of work. And so you try to outsource as much as possible via partnerships and via, employees, right? So on the single family side of my business, really the only thing ironically, on the single family side of my business, the only thing I really focus on is finding deals because of my relationships with my wholesalers that get me and my reputation that get me access to those distressed houses. So pretty much all of my time is split between finding distressed properties for single family houses and finding investors for large multifamily properties. Everything else is either outsourced to employees or to partners.
You explained that really well. Yeah. So it's very attractive to people to be passive investors. And a lot of the
Sure.
people that you work with, they get to just sit back and let you manage everything. Is that correct?
Yeah, so it's so funny because a lot of times I'll bump into people and they'll, passive investors, and they'll say, I want to do what you do. I want to be an active investor. I'm like, well, I want to do what you do. So when I started, I didn't have any money. And so that's why I took on more of an active role. But, I work with a lot of like doctors and like business owners, real estate brokers or mortgage, people that own mortgage companies and stuff. And they make a tremendous amount of money at their day job.
Mhm.
And they have tax issues. They have, what am I going to do with it? Inflation concerns and stuff.
Mhm.
So for them, it makes a lot of sense to just keep doing what you're doing and what you're best at, and then let me do what I can do and just make you money. Because it's really handsome returns. These apartment syndications over the last 3 decades have averaged 20% average annual rate of return, if not better, which
Mhm.
kind of equates to doubling your money every 5 years. And, in a world of tech startups and Bitcoin billionaires, we can get kind of blinded by this like lottery ticket type of
Sure.
expectations on returns. But in reality, if you look at doubling your money every 5 years, that can be very powerful and very life transformative. Right. Like, so if you put $100,000 in year one and you double it, after 5 years, you have $200,000. After 10 years, you have $400,000. After 15 years, you have $800,000. And after 20 years, you have $1.6 million. So like, if you think about it from the perspective of a 40-year-old starting to put in $100,000, which most 40-year-olds have access to via their retirement account or whatever, and you look at that doubling every 5 years over a 20-year period, now when they're 60, $1.6 million would be a rather convenient supplement to their retirement.
Oh, absolutely. Yeah.
And that's just a back of the napkin example of how
Mhm.
powerful that is. There's a tremendous amount of other examples that go into early retirement, and there's cash flow associated with it, and there's wonderful tax benefits through cost segregation and bonus depreciation. So it's great. And having, so I wanted freedom and security, and that's why I got into real estate. And I started buying rental properties, and I started flipping houses, and I got it. But what I found along the way was it was a tremendous amount of work, a tremendous amount of stress, headaches. And the average person is not going to want to go through that, but they can still benefit from all of the benefits of real estate. Because as we know, 90% of the world's millionaires were made from real estate. There's tremendous amount of benefits, and you can actually partake in that without partaking in the tenants and the toilets and the headaches and the stress. And so that's what a lot of our investors love about the arrangement.
Absolutely. And depending on how long you hang on to that property, you're pretty much going to get your money back. You don't have the high risk, let's say, of crypto that you mentioned earlier, where you might be an instant millionaire, but it's pretty safe, relatively safe. Yes.
Sure.
Yeah.
It's
About,
real.
yeah.
It's the value of
tangible. Yes.
Yeah, the value of 810, Wyoming Street, it's never going to go to zero. Like, there's always going to be value in the fact that could put a roof over somebody's head, and somebody's going to pay to have that roof over their head.
Right. Now, you mentioned how things have just gone up so dramatically in the past couple of years, and I know you don't have a crystal ball, but you obviously study the market. What do you think the next year or two are going to bring? Is this a good time for people to be investing both in houses or multi-unit? Or would you say one is better than the other now because rents are high?
I always say economics is a soft science, like psychology. Like, we can guess and we can look at general indicators, but we don't have a crystal ball. Like, on my podcast for years, I've interviewed some of the top economists and people that study this and very, very tenured, experienced real estate investors. And one thing I can tell you is that they all disagree.
Oh, okay.
And it's very, very smart. And you look at the top economists on the other side of the political spectrum in our nation, and they all disagree.
Of course.
And they both got like triple doctorates and all the, they're not idiots by any means. Like, they all get it. There's just you know what I mean? They just disagree. And, I've interviewed, because I've been doing the show for 3 years now. And I look back on people that I really, really respect and admire and take their advice, to a T. And I look at predictions they made 2 years ago and they're just flat out wrong.
Oh,
But I don't feel any different about them today,
I
knowing
understand.
that. There's things I was flat out wrong about. But if you want my opinion, which is, that's all it is my opinion, is that we won't see a crash because we might see a stock crash. We won't see a housing crash because of the supply and demand issues associated with it. Right. So we're, as a country, we're, several million housing units short, and we can't really build them fast enough for a number of reasons. One is supply chain issues. We can't get the materials. Number two is the labor shortages. And then number three is interest rate rising, right? Everybody seems to think interest rates are going to be what crashes the economy. And it certainly slowed the growth, but in order to build, people got to borrow money to build. And now it is more expensive for them to borrow that money. So less people are going to borrow money to build than, 6 months ago. So those, coupled with the fact that our population is not going anywhere. So we still need the housing units. We just can't bring them online fast enough. So I think that'll keep us from having any crazy dips. That being said, as somebody who sells houses, I have certainly seen it slow,
Right.
Whereas 5 months ago, I was getting 3 offers day one. Now I'm looking at, I've got stuff that's been on the market for 2 weeks and I'm panicking. Whereas I shouldn't be, right? That's really just a return to normal. You shouldn't get 10 offers on the first day. We've just been spoiled. You shouldn't have 0% interest rates. We've just been spoiled as a real estate investor community over the last 2 years, or longer than that. I mean, it's very reasonable expectation to, for your house to take you 3 weeks to sell your house, or, to have a 5 or 6% interest rate, to buy a home. We just, everybody's panicking because we've been spoiled recently.
Gotcha. So are there 2 strategies? I'm sure there are more than 2 strategies, but is it better to buy when prices are down and interest rates are up, thinking that you can refinance, or is it better to buy when prices are up, but the interest rates are down? What do you think about that?
This is an interesting question. So I would say buy when prices are down because you can refinance later. The other thing though is, if you're, and it's a loaded question. Let me start by saying that it varies just depending on what your everybody's situation is so different.
Sure.
So no single piece of advice fits everybody, but good cheap debt is great. I bought my house at a 2.93% interest
Good
rate.
for you.
Right?
Yeah.
And I might have paid more than I could have bought it in an environment where my interest rate was 6%, but I'm better off for having locked in that long-term cheap debt, because I don't know when I'm going to be able to come across that again. And is the house going to be for sale at that point?
Sure.
So I definitely like the low interest rates, but I mean, if I was in the market for a house, which I'm not, I would still buy a house. Now, I might be limited, right, by my debt to income ratios, and so a lot of people, that's a real thing.
Sure.
Whereas Johnny homebuyer might want to buy the house with hopes of refinancing later, but he might be limited from the fact that because the interest rates are so high, he can't
afford it.
that. It maxes out his DTI.
Right. You mentioned your podcast. I want to give it a shout out. It is called the Rent Roll Radio Show. Is that right?
Yes, ma'am.
Yeah, and I'm sure it's everywhere podcasts can be found.
It is. It's everywhere podcasts can be found. We put the videos out on YouTube. So
another thing I saw when I was reading up on you, that the exit strategy is very important. So
sure.
How do you know, though, what's going to happen with the economy? How do you figure out that exit strategy?
So, I mean, typically, so when I buy houses, I only buy between a certain range. I don't buy real high-end houses because, if I buy a $250,000 house and my intention is to flip it, right? And nobody buys and the market goes down and the value goes down and I'm stuck with it. I could always refinance it and keep it and rent it out. And a $250,000 house in my area demanding the rent that it gets, I can always stick a tenant in there, even if it's not great cash flow. It could at least like stop the bleeding, and so where I can weather the storm. But if I had like a $600,000 house in an area that only doesn't get more than $3,000 a month rent, like that's not going to cover that mortgage, and you're going to be losing every month holding on to it.
Mm-hmm.
So I always kind of make sure like I have other ways to get out of it, whether it's hanging on to it for a short-term rental, make sure it's everything we buy, you got to make sure you have cash flow. You're buying for cash flow rather than appreciation. And so with our apartment complex projects, it's like, make sure you have a long enough run on your fixed debt to where you don't balloon in the middle of a bad time.
Right.
Go for the 5-year fix versus the 18-month bridge.
Mm-hmm.
It gives you that runway of being able to take care of it. So I like, and I live by these rules, some days better than others, but
Mm-hmm.
I definitely think they're important. But I stole them from Joe Fairless, but he talks about like the 3 irrefutable laws of real estate investing, and it's to have adequate cash reserves, to have long-term fixed debt, and to buy for cash flow rather than appreciation. And that's how you pretty much stay out of trouble.
Wow. Wow. You've done a lot of studying and you're so very knowledgeable. I want to make sure that our listeners or viewers get your contact information.
Sure. So they can email me, sterling@crestworthcapital.com. They can follow me on Facebook, Instagram, Sterling R. Chapman. They can follow me on Twitter. I think that my marketing guy's doing TikTok and YouTube now too. So I'm really easy to find and get a hold of.
Well, I'm so glad you got out of the corporate world and are able to work for yourself and be so successful. And Sterling, thank you so much for being on the Icons of Real Estate podcast today.
Awesome. Thanks for having me.
Been great. Thank you.